Thank you for tuning into the Buyer's Guide podcast, where we talk all things property and finance. My name is Peter Mastriani, the founder of the Buyer's Guide, and today's cast will be part one of a three-part series which is focused on the overarching strategies involved within property investment, being active, passive, and alternative or emerging investment options. Now, passive investment or a longer term focus to property investment is what we're going to discuss today. So, let's get to it. Passive property investment strategy is really a long term investment approach which typically relates to a land banking type scenario. In that, if you've secured a property in a location that is going to be primed for growth and you hold it through all the ups and the downs of various property cycles, um, that's what a passive approach to property is. So, the more common passive options, the ones that we will discuss the merits of today, include five main ones. One is being defence housing, the second being the National Rental Affordability Scheme. There's residential and also commercial property, and we'll also discuss holiday or lifestyle property investments. So to start off, we'll touch on defence housing. So Defence Housing Australia is really a government-run residential developer. They build the property for defence personnel and then offer it back to investors in a lease-back arrangement, which can last from 3 to 12 years. So what does defence housing actually have going for it? Firstly, there's no vacancy risk. So if the property is untenanted for a period, the DHA will actually cover the rent. There's also no management responsibilities, so coordinating tenants and taking care of repairs and maintenance are all part of the deal. So, Defence Housing Australia will actually refurbish the property when tenants move on. Now, available stock will actually move pretty quickly. So, generally, investors are quite attracted to the long term security that can be offered within this arrangement. And newly built, um, they're mainly newly built, I should say, and that means that they can be depreciated quite quickly. So, what does defence housing actually have going against it? Well, even though it's a low risk investment with few responsibilities, it comes at a cost. Yearly management fees are between 13 to 16.5%, which is high. Now, higher fees equate to lower rental returns. If you borrow money to invest, it could mean that holding costs are higher than perhaps other property investment options that may be available to you. Location is another thing. Defence housing is usually built in areas that are going to be suitable for defence personnel. Um, and that doesn't necessarily equate to a great location. So, in turn, it's going to impact on the capital growth potential. The properties are also generally concentrated in that location as well. They're large in volume and the quality can be quite basic. So having lots of the same thing in the same place at a low quality again really won't favour the capital growth prospects. There's also little flexibility in this arrangement in that you can't go in there and try to manufacture equity through a strategic renovation, for example, or you can't increase the rent outside of what the DHA also sets out, which is typically in line with inflation. So, look, I guess in conclusion, if you are interested in significantly reducing your risk, responsibility, and the running expenses, all those factors do come at the cost of a reduced yield, which is due to the high management fees that are involved, and the capital growth prospects can actually be quite weak with some of these defence housing properties. So these downsides mean that less profit can ultimately be achieved at the end. There's always a catch in that risk and reward type trade-off. So the suitability of defence housing, I guess, will really depend on your actual appetite for risk and your appetite for returns and your objectives around each of those. But when we're talking passive, this is, really about as passive as property investment gets. Now, just as a final note, throughout 2015, there was some speculation that the federal government was actually running the ruler over this scheme, and rumour had it that it was actually going to be earmarked for privatisation. So, time will tell in this instance here. Now, let's move on. The National Rental Affordability Scheme. Um, so, the government brought this in 2008, and it was part of a strategy to really address housing affordability. $10,917 is the figure that's actually paid annually as an incentive, as a condition for the 10-year period that the dwelling will have to be rented for 20% below the market rate for eligible low income households. The incentive is indexed against CPI, so the total return over the 10 years will actually be greater than $110,000. The real benefit of actually buying a NRAS property is that you can claim the maximum tax loss plus also receive the incentive. So in many cases, this will actually turn the property from a negative to a cash flow positive property. Now, to qualify for the program, each NRAS property must be brand new and purchased directly from the developer. So the benefits consist of improved rental yields, tax-free incentives. There's quite a large pool of eligible tenants, um, a, a secure income stream, and look, obviously, the tax benefits as well. Plus, if you are providing a new dwelling to someone that perhaps wouldn't necessarily be able to normally afford to live there. So, you're giving something back as well, which is good. Now, just like any other investment, some will perform better than others. And the same will apply for the NRAS scheme as well. So each property really needs to be treated on their own merits. Plus, a large development with lots of new stock coming onto the market all at the same time, really won't do you a lot of favors from a valuation perspective. If you feel that this could be an investment for you, then you will have to move pretty quick because the NRAS scheme was funded for 50,000 dwellings, but will end on new investments on 30 June of this year. But owners will still get the tax incentive for the 10 years from purchase. Residential property. It's what people know, like, and trust. It's the darling of the property industry. We grow up in it, we entertain in it, we live our lives in it, raise our families, and a lot of people use it as vehicles to generate wealth and to actually secure their future. It's, good old fashioned residential property. So, what's the actual attraction to it? If we take aside the emotional elements to it, it's actually pretty low when it comes to the volatility stakes. There's some nice tax advantages to it, particularly if you're going down a negative gearing approach. Um, there's prospects for capital growth. You can generate income, and there's demand for it. Now, the downside of residential property centers around, the high cost of entry. And it isn't exactly a liquid asset either, meaning that, it's not easily going to be converted into cash. So the establishing costs, the fluctuations in interest rates and risk will be centered in that specific location, meaning if you unfortunately buy in the wrong location, there could be a real risk of the value actually stagnating or worse, decreasing, but demand for residential property will likely remain strong, not only for owner occupiers, but also for investors, because the familiarity of the asset class, it's easily understood, and people will invest in what they know and what they're comfortable with. This is the true underlying beauty of the asset class. Now, you can investigate and dig out various numbers, statistics, charts, and compare the difference between property and shares. Each will vary and tell you a different story. If you pull the data from 2013 and look at the 10-year average, it'll actually indicate that shares have probably been a stronger performer. If you pull the data from today in 2016, that the reverse is true, in that you'll see that property has outperformed shares for the past 10 years. So, it's important to note uh, that both investment classes achieve the best gains over the long term, particularly in property. Now, you can get lucky and jag a really good buy, flip it and turn a quick profit, which is great. Lots of people do it. It's a good strategy. However, in most cases, property performs best once you've held it for 7 to 10 or more years. Leverage is also a powerful tool to build wealth and is really put to best use via residential property. So, leverage through bricks and mortar was the secret sauce of the baby boomers, contributing, to their success as investors. The beauty is that you can borrow more when you use the property as security compared to, say, a share portfolio, for example. Lenders can provide finance for up to 95% of the value of the property, whereas they may only lend 50% against a share portfolio, and you don't have to run the risk of having a margin call when it comes to property as well. So the borrowing power will actually allow you to benefit from the capital growth of a larger investment. Um, Another nice thing that you can do with residential property is that you can actually manufacture equity. Um, and look, this can be done by adding value, and you can add value through renovations and improvements. A really well-timed strategic renovation can significantly improve the value of the property. These kind of options are all available because you have 100% control of the asset, meaning that you can influence the asset's overall worth and the cash flow depending on what you do and what you don't do to that property. Now, while the entry costs are high, um, there can be some tax deductions. So, ongoing costs can be high as well, and the revenue received can offset those costs, obviously, and contribute to the overall reduction of the mortgage. So, in time, the asset will actually start paying for itself and bring you a revenue stream in retirement if you hold it for that long and if you desire to have it set up in that manner. Um, and it's possible to even pass the asset on to future generations, again if desired and if that's what your strategy is. Well, um, the beauty of property though is that it's tangible. You can touch it, feel it, drive by it, and know that it's going to be safe. These factors alone give a lot of comfort for investors, which is needed from an emotional perspective considering the sum of the money involved. Importantly though, you need to make decisions with your head, not your heart, because investing in property should be treated like a business. But we'll discuss that more at a later stage. Commercial property. So, um, demand, I guess, drives capital growth in the commercial property space, and demand is directly linked to capital growth. So, historically, this has meant that commercial property is far less predictable compared to the residential markets because of longer vacancy periods and sometimes poor resale value for more specialized assets. Now, the asset can be held in a similar manner to residential property, being in under an individual's name or a company's name or syndicate or a trust. Um, Self-managed superannuation funds can provide investors with good benefits and are particularly useful for the self-employed. Self-employed person can set up their SMSF and purchase a commercial asset, which could be suitable for their business operations, and then they can rent it to the business. Um, there's significant advantages in this type of arrangement, and probably best discussed directly with your accountant, but uh, that could be quite lucrative for you in the long term. Now, some of the key differences to be mindful of. When it comes to commercial property, longer leases are put into place, but vacancies between tenants can also be longer. Maintenance costs are usually covered by the tenant, which means that your net income can be higher, and GST will be applied to the rent received along with any expenses relating to the property, including rates, water, and other expenses. Now you can claim the GST back as an input tax credit against GST charged on the property's rent. So, what are some of the issues of commercial property? Um, Location is a big one. The actual access to transport, that the visibility of such, and also the surrounding businesses as well can also impact. So there's infrastructure to take into consideration. So you need to investigate the future development potential, as it'll either have a positive or a negative impact on the property value. Tenant quality. A strong government or a corporate client with a long lease is going to be on the wish list of every landlord. But most importantly, you need to consider the financial strength of the tenant and their overall potential longevity as well. The building, the actual physical asset itself, the overall quality and condition of the property is obviously going to have an impact on your return. And the final thing to consider is the actual yield. Um, uh, in terms of rental reviews, if they're going to be aligned to CPI increases or if they're going to be incremental, along with, who covers what with the outgoings. They're all going to have an impact on the overall yield that is actually achieved. Now, more recently, commercial property has really started to um, gain in popularity as investors are chasing and wanting to secure good, stable, income-producing assets. So, properties that attract, blue chip tenants that are linked to long leases are really in high demand. So, established franchises, for example, like Red Roosters or KFCs, Hungry Jacks, BP service stations, Bunnings as well, are all very attractive investment prospects because in these cases the average annual after-tax return over 10 years will be in excess of 10% and much higher once capital growth is actually factored in. So the last passive investment uh, strategy around property that we'll discuss is the lifestyle focus or getting the holiday unit. Now, who doesn't actually want to have a property at the beach? I do. It's a dream of all investors. The trouble in this scenario boils down to, I guess, buying with your heart as opposed to your head. Plus, understanding how holiday rentals work and income produced is going to fluctuate. Peak demand for these properties may only last 8 to 12 weeks of the year, and depending on the location, the views, the actual quality of the property, and the management, they're all factors that will influence the overall vacancy rate. So, volatility in this sector can certainly be high. As they're an expendable asset, and they're probably one of the first things to actually go if the owner starts to actually experience some financial hardship. Now, finance policy relating to a holiday home can also be slightly different relating to the LVR requirements. Typically, they will be lower than what would be required to purchase a property on an owner-occupier based status. Tax can also be a little bit more complex if you maintain it as a rental for only part of the year. The reason is that I guess you need to convince the ATO that the actual purpose is a genuine investment. So if that's kosher, you could claim deductions like interest expenses, but they will need to be prorated against the time that it was actually rented and used for personal use. Capital gains tax will also apply upon the sale of the property. Consistency of cash flow, I guess, is the real issue in the situation here. If you're a first time investor and you do need consistency, it may be better to consider, some alternative investments. On the other hand, if you're a wise old dog and you're looking to diversify and lifestyle factors being an important consideration, then a holiday home could well be worth considering. So having a home away from home that generates some income is great. You just need to remember that the offsets could include long periods of vacancy, that there are some tax issues relating um, to the separation of income and the purpose of such, and also there could be additional wear and tear on the property and your possessions as the various people will pass through. So that concludes part one of our three-part series focused on the overarching strategies involved in property investment. Be sure to tune in next week where the discussion focuses on taking an active pursuit to property investment through development activity. So thanks for tuning in, and if you would like to discuss your own individual circumstances relating to property investment, feel free to get in touch with me via www.thebuyersguide.com.au. Thanks again. Bye bye.